Yeah,
Oh, that's
gentlemen,
Okay.
and Kelly, thank you very much for taking the time. I know it's quite demanding for everybody. It's yeah, very difficult time for every one of us. Very demanding as a citizen, as a businessman, as an investor, as a market commentator, whatever. But yeah, there's also going to be lots of topics to discuss today. And I don't know, Jim and Rick, do you know each other? Probably.
Well,
Yes. Okay. So I will make the official introduction of Rick. Rick began his career in the securities business in 1974. No, that cannot be true. It must be 94.
no, true.
Really? Okay. Well, so you have to tell me your secret how to look that young. It cannot be investing in junior mining stocks because I lost all my hair during that short time. And in 1974, and has been principally involved in natural resource security investments ever since. He's leading resource investors specializing in mining, energy, water utilities, forest products, and agriculture, and has originated and participated in hundreds of debt and equity transactions with private, pre-public, and public companies. Mr. Rule is also the founder of Global Resource Investments, president and CEO of Sprott US Holdings, Inc., a member of the Sprott Inc. Board of Directors. He's a frequent speaker. He's a fantastic speaker at industry conferences and has been interviewed for numerous radio, television, print, and online media outlets concerning natural resource investments and industry topics. Mr. Rule is frequently quoted by prominent natural resource-oriented newsletters and advisories. And he's also a very down-to-earth, very gentle and thoughtful gentleman. Always a pleasure talking to you. Always a pleasure listening to your keynotes. And as far as I know you, you're one of the most hardworking men in the whole industry, because at every conference that I attend, you're always one of the first there, and you're always one of the last leaving, and you're always open to talk to basically everybody. So, Rick, it's a great pleasure having you today, and yeah, welcome to our advisory board call.
Well, thank you for that flattering introduction, and I'll return it. I really enjoy the work that Incrementum does, in particular the annual gold books. I really look forward to them. I'm delighted with them as an information product, and frankly, as an entertainment product. All of the work that you guys do, being able to make it both topical and humorous simultaneously is a great joy. So thank you for all of the work that you do, and thank you for putting on this webinar at this point in time.
Thank you very much. So
with your,
yeah,
go ahead.
So Sprott is also a premium partner of our In Gold We Trust report. Thank you very much for that. As you know, we are currently writing, editing, proofreading, researching 24/7 for the upcoming In Gold We Trust report. It will be published on 27th of May. And of course, I mean, it's a big challenge writing about the gold market, about mining stocks, about central banks at the moment, because every day there's so much going on that you can literally write a book about those developments. But we're doing our best. We've got a fantastic team, 17 people working on the report. And as I've said, 27th of May is the big date. It is published in German and in English and in Mandarin. It's available for free for everybody, because we think it's important to put out really serious information about the portfolio characteristics of gold, about how gold and mining stocks work in your portfolio, the disadvantages and the advantages, valuation, and so on. So without the help of our premium partners, this wouldn't be possible. So also thank you very much to Sprott for supporting us. Gentlemen, just a few housekeeping things before we start the discussion. As you know, we're currently writing the report. We just published the English translation of our book, the zero rate trap, the zero interest rate trap. We published a chart book on gold, where we actually said that a recession is around the corner. Of course, that was before the whole COVID-19 crash. We just published or launched a new fund, a fantastic fund that combines physical gold and Bitcoin, digital gold. So it's 75% physical gold and 25% Bitcoin with an options overlay. So actually volatility, and there's enormous volatility in the Bitcoin space. It's not an enemy, but it's our friend. So we try to use that via an options overlay that Mark manages very, very well. And yeah, that's basically it, what's going on over here at Team Incrementum. Of course, everybody is working from home. So if you should hear children screaming, that's probably gonna be my girls. I hope you understand. I'd say, Mark, I hope I didn't forget anything, but I'd say let's jump into the discussion, and I would like to ask you a bit of a provocative question first. And I would like to ask you, gentlemen, if you were President Trump or Jay Powell, what would you do, or what would you have done in the whole situation? So in terms of fiscal stimulus, but also in terms of monetary stimulus, what would you have done, and how satisfied are you with the steps that were taken? And of course, what do you think will be the consequences of those enormous and unprecedented monetary and fiscal stimuli? Who wants to go first? Our guest, Rick?
Perhaps James should go first. He was actually in the belly of the beast, and at least indirectly part of the government. So I'd like him to go first, if I may.
Who says indirectly? Thanks, Rick. To answer Ronnie's question, there is no fiscal stimulus and there is no monetary stimulus. There is an expansion of the Fed's balance sheet from where it is today, $5 trillion, which is higher than the peak of 2014 at the end of the taper in QE3. It's on its way to 10 trillion. I can explain $10 trillion. I can explain that if you like, but that's where it's going to be fairly soon. And we had a $1 trillion deficit for fiscal 2020 going into the crisis. That deficit will now be at least 3.2 trillion based on the $2.2 trillion rescue bill that was passed last week, although I think it's almost a certainty that we'll have at least another trillion on top of that. So we're looking at a deficit for fiscal 2020 of $4.5 to $5 trillion. So you'll have a $10 trillion Fed balance sheet. You'll have I'll say $5 trillion deficit, which by the way is 25% of GDP for 1 year. 25% of GDP deficit for 1 year, and the Fed balance sheet will be 50% of GDP. It's a little apples to oranges because one's a balance sheet, one's in effect an income statement or gross receipt statement. But so the Fed will be 50% of GDP and the budget will be 25% of GDP. None of it will provide any stimulus at all. Now, I suppose I should give some reasons for that. The Fed is doing probably what it needs to do to keep the lights on. They have thrown liquidity wherever it's needed. So they've, in addition to the primary dealers and the big banks, which is kind of business as usual, they've guaranteed the commercial paper market. They've guaranteed all the money market funds. They have, in effect, guaranteed the corporate bond market and the municipal bond market by buying those assets. They have pre-announced that they're going to buy the small business loans originated by the banks, so they're already government guaranteed, but now they'll be not only government guaranteed but owned by the Federal Reserve. So they are throwing liquidity where it's needed. They are keeping the lights on. They are making sure that the liquidity, the plumbing, if you will, the financial system is not jammed up, but none of it will have any effect on growth or provide any kind of stimulus. And the reason for that is money supply has nothing to do with inflation. That's something that's kind of been, perpetrated by or propagated by Austrian economists, monetarists, Milton Friedman, even the neo-Keynesians are on board now. But inflation is not caused by money supply; it's caused by velocity, is the technical name. In other words, the turnover of money. So if I feel prosperous and I go out to dinner and I tip the waiter, and the waiter takes a taxi home and tips the taxi driver, and the taxi driver puts gas in her tank, in that example, my dollar has velocity of 3. It supported a waiter's tip, a taxi driver's tip, and a tank of gas. But if I decide to stay home, which I'm doing lately, and watch television, my money has velocity of 0. And I remind people that $5 trillion times 0 is 0. In other words, if you don't have velocity or turnover, you don't have an economy. So the problem with getting the economy moving, even in nominal terms, certainly real terms, and getting any kind of inflation or avoiding deflation, is one of velocity, which is a psychological problem. It's not a monetary problem. The Fed can, at least as far as base money, REM 0 is concerned, the Fed can stick the landing. They can make that anything they want to 2 decimal places, but they can't change how I feel. They can't change how the American people, I'll extend that globally, feel right now or in the future, I expect. So we have a declining velocity, which, by the way, started in 1998. There's nothing new about the decline in velocity. You can go back and look at the charts on that. It got it went down a little more steeply after 2008, but it was already trending down. Nothing the Fed has done, nothing anyone has done has been able to bend that curve, and now it's probably going to go vertical to kind of approaching the x-axis. Fiscal policy will not provide any stimulus. I just talked about a $5 trillion deficit for fiscal 2020, but the Keynesian remedy, Keynes called it his general theory of employment, income, and money. The phrase general theory is a little bit of Einstein envy, but in fact it's a special theory, which means it works in limited circumstances. So Keynes identified the liquidity trap, and if you're coming out of a recession or in one, or a depression for that matter, and people won't spend, they're saving, you substitute government spending for individual spending, and if you have a manageable, sustainable debt load, excess capacity, and you're in a recession or a liquidity trap, there's some evidence that the government spending can create the famous Keynesian multiplier. So you borrow $1, spend $1, and you get, say, $1.20 of GDP, and that's a way to get the economy moving, or as Keynes called it, the animal spirits, and pull yourself out of a recession. Query whether those effects are permanent or temporary, but temporary works when you're stuck. But the research of Ken Rogoff and Carmen Reinhardt, she was at the University of Maryland, she's now at the Kennedy School, Rogoff is at Harvard, over centuries, broken down by developing economies, developed economies, all economies, specific subsets, specific timeframes. Every way you can slice it shows the same result, remarkably consistent, which is that when debt to GDP exceeds 90%, when that ratio exceeds 90%, the Keynesian multiplier falls below 1. In other words, the shorthand for that is you can't borrow your way out of recession. Well, at least not if your debt to GDP ratio is over 90%. So the U.S. went into this crisis with a 106% debt to GDP ratio, which is one of the reasons we had such pump growth from 2009 to 2020. Notwithstanding the $870 billion shovel-ready fiscal stimulus in 2009, it didn't work. It's not going to work now, and the reason is because as a physicist would say, we've crossed the critical threshold to the point where now you borrow $1, spend $1, and you may not get 90 cents of growth. Forget about the $1.20. So fiscal policy will not work because the debt to GDP ratio is so high. We're going to take it to about 115 to 120% as a result of the deficits I just mentioned. We're catching up with Italy. We haven't quite caught up with Lebanon and Greece yet, but we're getting closer. But that's why fiscal policy won't work, monetary policy won't work, because the problem is not monetary, it's psychological and related to velocity. So these two, so if you want to call the spending bill spending, that's fine, but don't call it stimulus. And if you want to call monetary policy keeping the lights on, that's fine too, but don't call it stimulus. So there's no way out of this, but we will run up a lot of debt and print a lot of money.
Rick, you want to go next?
I'm delighted that I let Jim go first. And I agree with most of what he said. I think it's very difficult to borrow your way out of recession when you have too much debt to begin with. It's sort of like the old adage, when you're deep in a hole, stop digging. And that's the circumstance that I see ourselves in. I think the name of this year's book sort of defines the problem. The zero interest rate trap sort of goes a long way to describing the efficacy of the policy responses that are forced upon the politicians today. In direct answer to your question, what would I do were I Trump? Certainly, given the excesses of the last 20 years, had I been elected president, I would have demanded an immediate recount. Because the circumstance that we're in is a circumstance of our own construction, going back, as Jim suggests, 20 or 30 years. And I would suggest merely to echo what he said, but also to echo the title of your book, that we are in a trap that we've spent 20 or 30 years constructing. And my suspicion is that the way out of the trap will be ultimately that markets work, which is to suggest that we have a bit of a reckoning to deal with as a nation and as a society. I would go further to say that the debt that we have and the artificially low interest rates that we've constructed, the whole sort of political fiscal construct that we have, is part of a trend that I've described as a war on savers. In democracies, the truth is spenders who are more numerous vote to redistribute the wealth of savers. It's very difficult to spend your way out of a circumstance where you owe too much. But the nature of a democracy, of course, is that spenders who are numerous vote to redistribute the wealth of the savers, which is to say that they vote to decapitalize the system that exists. And there needs to be a reckoning to get our way through this. I don't think it's going to be particularly pleasant, but that notwithstanding, I think it needs to occur. There's a great old libertarian lapel pin that describes democracy. By the way, I'm not necessarily knocking democracy, but there's an old lapel pin. This will play better in the United States than in Europe. That a democracy is where 4 coyotes, predators, and a lamb vote on the lunch menu. And the circumstance that we have today really, I think, is partly the consequence of a politically popular war on savers by spenders. And there is going to have to be some sort of unwinding of this. But as I say, in direct answer to the question, had I been Jay Powell, I wouldn't have accepted the nomination, given 30 years of history. And were I President Trump, I would have demanded an immediate recount had I been elected. I don't think that this will be an easy problem to solve politically, because I think politics is what caused the problem.
I'm glad that, by the way, I agree with what Rick said. I'm glad Rick used the word politically. He said it will not be an easy problem to solve politically, and I agree with that. It's actually a trivial problem to solve economically. You can solve it in 15 minutes, but the politics and I won't say lack of education, I'll say miseducation that stands in the way of that are daunting. We talked about the debt. And Rick's exactly right. That's just a way of deciding to eat the lamb. It's a way of pushing the burden onto someone else, disenfranchising savers, et cetera. By the way, interest rates today are sky high. They're not low when you think about them the right way, which is in real terms, not nominal terms. Nominal interest rates are at or near historic lows, lowest ever in U.S. history. But in real terms, they're quite high. And let me illustrate that. In 1980, I took out my first mortgage to buy a condo in New York, and my interest rate was 13%. And my mother cried because her first mortgage was about 2%. And she said, "That's so much money, you're paying so much money." But I said, "Mom, inflation at the time was 15%, which meant that my real rate was -2. And I was living in New York, so taxes were 50% and the interest was deductible. So my after-tax real rate was -8. That's cheap money. -8 real rate is cheap money. Today, interest rates are, say 50 basis points on the 10-year note yield to maturity. We haven't seen this in the data yet because the data haven't arrived, but I use a lot of inferential method, and I think we know enough to make a fair inference that we're in deflation. Which means that if nominal rates are 50 basis points and deflation is even 1%, that's not an extreme estimate, the real rate is positive 1.5. So my 13% mortgage had a real rate of -8, and today 50 basis points is a real rate of positive 1.5. That would be my estimate. So not to belabor it, but real rates are actually quite high. And I spoke to I was in a closed-door meeting up in Bretton Woods last summer before the COVID thing, but economic growth wasn't any great shakes. We had two senior Federal Reserve Board officials, one governor and one head of research for a regional reserve bank, and a member of the governing committee of the ECB. So real central bankers, kind of off the record. But they made this distinction. I was pleased to hear it. I was like, well, I'm glad somebody understands it. But they were talking about the difference between real rates and nominal rates. And they made the point that it's real rates that drive the economy. It's real rates that drive borrowing and lending decisions and velocity and the kind of things we talked about. So at the time, the 10-year note yield to maturity was so close to 2%. Of course, it's collapsed since then. But inflation was 1.5. And so they said the real rate is still positive 50 basis points. We've got to get the real rate negative, but it was like a cat chasing its tail. In other words, the more disinflation got a grip, and I would say today we have deflation, but at the time it was disinflation. They said if inflation is going down and we want to get nominal rates below inflation to get negative real rates, guess what we have to do to nominal rates? And I said last summer, I said rates are going to zero, and I didn't base that on COVID because who heard of COVID? But I based it on what central bankers were telling me. There's no saying don't fight the Fed, but I'll take it a step further. When they tell you to your face that rates are going to zero, you should bet that they're going to zero, and here we are. But it's worse than that. And then they pivoted into negative interest rates. And just to be clear, they didn't say they were going to do it or it was a policy decision, but I was surprised at how relaxed they were talking about it. That, yeah, it's just another tool in the toolkit. Yeah, it's on the table. We'll look at it when the time comes. Well, the time is now. So don't be, let this play out over the next few months, but don't be shocked to see the Fed go to negative interest rates, which of course we already have in ECB Switzerland, the ECB Switzerland, Sweden and Japan and a few other places. Without going on too long, I'll make the point that negative rates don't work, but just because things don't work doesn't mean they won't be tried. So, so what you need, so how do you get out of this debt burden, this debt overhang? There are a couple different ways to do it. Going back to the maybe fourth millennium BC, continuing through the book of Leviticus and over throughout history, there's something called the Debt Jubilee, which is administrators, kings, whatever, understand that people borrow too much, lenders lend too much, the system gets overburdened with debt, it becomes a drag on growth, and you have to get rid of it. So what do? So what they did in antiquity was just forgive all the debts. Like all debts are forgiven as of now, wipe the slate clean, and let's start over. And that actually works. And people say, well, gee, isn't that a little rough on the creditors because they're getting wiped out? But the answer is that this was done, and this again specifically from the book of Leviticus, this was done on a schedule, 50 years, 60 years, whatever the tempo was, and you could see it coming. So if you just had a Jubilee, last year, and you got 50 years till the next one, you could feel pretty comfortable making a 10-year loan secured by property or crops or whatever collateral you want. But if you're in year 45 of since 45 years since the last Jubilee, you're not going to be making any 10-year loans. You might not make any 2-year loans. The point being, it was a way of descaling the system. The system voluntarily and with foresight reduced the amount of debt on its own, knowing that the Jubilee was coming. Why would you want to be the big creditor on the day of the Jubilee? You wouldn't, because creditors, for the most part, aren't stupid. So, but what it was self-regulating, it was self-equilibrating, and the debt would come down as the Jubilee approached. So when the Jubilee actually happened, it wasn't as traumatic as it might sound, certainly today, because the system had self-regulated. You avoided the excess, and then you started over. I don't think that's going to happen, but it's kind of in the air. The other ways of dealing with debt, one, you just don't pay, like the Argentinian solution that works. It can have a rough few years afterwards, but creditors have short memories. You have a restructuring that was done in the case of Greece. Greece. By the way, I'm being handed a note that Bernie Sanders just dropped out of the race, so if we're not multitasking, I'll pass that along to the group. Now we can look forward to President Biden. So restructuring is, again, the Argentinian solution. There are variations on that. You can say, capital controls here. I'm going to pay you, but as they said at Gilead, come and get it. I've got 100% capital controls or whatever. They're all sort of halfway measures, and they work for everyone except the United States. There's no reason for the U.S. to not pay or to even restructure its debt, because we can print the money, as I said earlier. So what's the best way out for the United States? Well, the American way, which we've done many, many times, it works like a charm, is inflation. Even modest inflation, 3% a year for 18 years will, 20 years will cut the value of the dollar in half. So that's how historically between 1945 and 1980, following the Civil War and other periods, we have got out of debt with inflation. The problem is that, as I described earlier, inflation is a psychological phenomenon. So you actually have to change psychology, which is more to it than money printing. So I'll give you my 15-minute solution, then I'll shut up. And this will be music to Rick's ears and my own. You call an emergency meeting of the Federal Reserve Board. You get the governors in a room. You take a vote. You walk out of the room. You walk up to a microphone and you say, my fellow Americans, this is Jay Powell speaking. My fellow Americans, as of now, the price of gold is $5,000 per ounce. And if you think that's cheap, come and get it. We got Fort Knox, West Point. The doors are open. We'll ship it, to any address you say. If you think it's rich, we'll buy it from you, and we've got a printing press to prove it. In other words, you use the U.S. gold hoard, the 8,000 tons, and the printing press to conduct open market operations in gold, no different than you would do in 10-year notes or treasury bills or anything else. And so if 5,000 is your target, you're a buyer at $49.75, you're a seller at $50.25. You've got the actual gold and the printing press to do that. If you do it, guess what? The price of gold is $5,000 an ounce. Now, here's the point. Why would you do that? Not to enrich gold holders or gold miners or anyone else. The idea is that nothing happens in isolation. $5,000 gold is the world of $200 oil, $100 silver, $20 copper, etc. You would do it to inflate the price of everything else, because $5,000 gold doesn't actually mean anything for gold. What it represents is an 80% devaluation of the dollar. If I have an ounce of gold and I stick it in a drawer and I go away for a year and I come back and I open the drawer, it's still an ounce of gold. It didn't add on, or there's no dividends or buybacks, or it didn't reproduce. So gold is just gold. But by raising the price, you're devaluing the dollar, and there's your inflation. And by the way, this has been done twice in U.S. history, once on purpose, once by accident. On purpose was Franklin Roosevelt in 1933. 1927 and 1933 was the longest period of sustained deflation in U.S. history, and the price of gold went up 75%, from $20 an ounce to $35 an ounce. The government did that on purpose, not to enrich gold holders. In fact, they very cleverly confiscated all the gold before they did it so they could pocket the insider trading profits. But it was done to get the price of everything else to go up, and it worked. 1933 was one of the best years in the history of the stock market. There you are in the middle of the Great Depression, and you've got a huge stock market rally. and the economy expanded, unemployment dropped. It worked like a charm, but the purpose was to get the price of everything else to go up, break the back of deflation. The second time it happened was by accident in 1971. Richard Nixon suspended the redemption of dollars for gold by our foreign trading partners. It took a few years to get traction, but by between 1971 and 1980, the price of gold went up 2,700%. And inflation skyrocketed, back to my story of the 13% mortgage, which was cheap. So the point being, you can get inflation in a heartbeat. You can't get it by printing money. You can't get it by jawboning. You can't get it by, flooding the system with liquidity. You can get it by changing the psychology. And the proven way to do that by FDR and Nixon is to devalue the dollar. There's your inflation instantaneously, and you do that by raising the dollar price of gold, because gold is the only numeraire where you can't print it and it's not done by fiat. And the dollar-euro exchange rate, yeah, interesting if you're an exporter or a currency trader, but it doesn't mean anything because you're measuring one paper currency against another, and they're all in the same boat. But when you have an exogenous metric such as physical gold, you can do it.
Thanks a lot, Jim. Mark, do you have a question?
No, thanks for the first two contributions. Very interesting. I've just got two small add-ons. I mean, that's just a minor correction, perhaps even in the back of the envelope calculation. Jim, you told us. Because you said, well, you're expecting potentially a 5 trillion deficit this year, which adds up to roughly 25% deficit GDP. That, if I didn't miscalculate that actually doesn't take into account a recession this year, or does it? Or just to specify, do you have some kind of estimate how deep this recession is going to be, how much the GDP will actually shrink?
That is a very good point, because you're right. I was using my baseline is about $20 trillion, but the expectation is that GDP will shrink, at least in the second quarter, by, take your pick, you hear 20 to 30%. So you're exactly right. If you took off, let's just say 20%, which is conservative, take off $4 trillion of GDP on an annualized basis, all of a sudden 20 is 16, 20 trillion becomes 16 trillion, and 5 trillion looks more like 1/3 of the of GDP. So you make a very good point.
Right. Okay. Well, we will see. I mean, it's very difficult to estimate, but I also think this is currently completely underestimated in most of the research I saw. But that's a moving target. And the other point is just a side note. This point you brought up historically already, Jim, regarding the relationship and the potential revaluation on gold. I actually asked this exact question to former Chairman Greenspan via a letter. I mean, it's a little bit of a long shot, but he did already respond to me once a few years ago. So we'll see if he answers this and some other interesting questions. I asked him, perhaps we can have some kind of a interesting news in news content piece for our next report. But I think that will be a very interesting thing to watch out.
Yeah, I agree. And if I could just drop a really quick footnote, the two times I mentioned FDR in 1933 and Richard Nixon in 1971, both times we were on a gold standard. Now it was a messed up gold standard, not the classic gold standard. I understand all that, but there was a fixed price for gold, and so you could raise the price of gold, which I really think of as devaluing the dollar by government fiat, which is what happened. The problem not the problem, just the case today is that we're obviously not on a gold standard, meaning that individual investors, institutional investors, can front run the inevitable. Get your gold now. Of course, I said this years ago, but get your gold now, and then you will be the beneficiary of the inevitable, which is that the price of gold is going to have to go up a lot in order to get the inflation that is necessary to diminish the real value of the debt. So you can front run your own government. I mean, in the case of FDR, the government was front running investors, but now the shoe's on the other foot because you can actually go buy gold at the market, and you can front run the government.
Great. So why not pass over to Heinz? I'm sure he has something to add regarding all this.
Okay. First of all, Jim, I would like to correct your view of the Austrian.
Heinz, sorry, you're very, very soft.
Okay. Is it better now?
Yeah.
Okay. So, Jim, I would like to correct your view of the Austrian view of inflation, of price inflation in particular. So, it's true, we are not really worried about velocity, but what you call velocity, the Austrians refer to as the demand for money. And the supply of money is just one of 4 variables, okay, of the money relation. One is the supply of money, the other is the demand for money, and the other 2 are the demand and supply of goods and services. So these 4 variables interact with each other to give you the purchasing power of money. So it's clear, money supply increases alone are not going to produce nominal price inflation necessarily if the demand for money, for instance, is greater than the addition to the supply. But one thing is clear, if the supply of money increases, prices will be different than they would have been without the increase. Because some of the recipients of the new money are going to spend it. So price relations within the economy are going to change. Relative prices are going to change. That's one thing I wanted to quickly say. And as to the question, what would you have done in the place of Mr. Powell and Mr. Trump? Well, I wouldn't be in their position because just like Rick, I would have resigned the day they nominated me. And in my opinion, it is indeed a self-inflicted wound in a way. I mean, the pandemic could not have been foreseen, or let me rather say it could have been foreseen actually. It was foreseen, to be precise. There was actually a conference half a year before the pandemic broke out in which they discussed just such an event as a very likely thing to happen within the next few years. So it's not something that should be too big a surprise. But anyway, let's just call it a surprise for the time being, for argument's sake. Now, if we had not produced this giant bubble in everything, in credit and asset prices and so on, then there would not be the need for Mr. Powell to douse all sorts of fires in the credit markets by printing money. And frankly, once the crisis is over, we will once again find that the Federal Reserve will probably find it impossible to take any of these new facilities back in a significant way. In other words, I don't think that the balance sheet is going to shrink after this is over. It's probably going to stay as big as it now gets. And we will have sown the seeds for the next bubble. So it's a never-ending vicious circle, actually. And it's clear, one of these days it will end. And it's quite possible that this event is going to end it, depending on how long it takes for the pandemic to recede. So anyway, I understand, of course, that the situation as it is forces these people who are in charge to do the things they are doing. There's nothing else they can do. It's what's expected of them, so they are doing it.
And I mean, it's highly path dependent. I think if you already decided to go along this path, you're basically stuck, and we're seeing that on an international basis, that basically everybody is going that way. And I wouldn't want to be in the position of a politician at the moment. I mean, it's probably really hard to make the right calls at the moment. Heinz, you were referring to what I just described in a new keynote, and I called it the black swan that wasn't, because Talib just said that actually what's going on at the moment, so the coronavirus, the COVID-19, is not a black swan, because it's completely the wrong metaphor, because actually he consulted the Singaporean government, because a pandemic actually is something that every government should have been prepared for. So actually I looked that up, and it seems that the proper metaphor would be a gray rhino, which is something that is highly probable but neglected. And actually there's an economist, Michel Booker, I didn't know him before. He wrote a book about that, The Gray Rhino, how to recognize and act on the obvious dangers we ignore. So it seems that I think that COVID-19 is not a black swan, but it is actually the actions that were taken by politicians and central bankers and their impact on real economy, businesses, wealth, society, and financial markets. That's probably the real black swan. So Jim, you're on the East Coast. Rick, you're probably on the West Coast right now. I would love to ask you what the whole situation is over there in the United States, and specifically East Coast versus West Coast. Over here in Europe, and especially in Austria and in Liechtenstein, at the moment everybody thought, okay, we'll just make the best out of it. And now after, I think it's 4 weeks of lockdown, and they just said, okay, we won't be allowed to make any business or any trips abroad until the summer. Shops will be closing up, but only very few different businesses are allowed to open up after Easter. So we will have much more restrictions, and it seems so far everybody kind of believes, the consensus believes, okay, politicians will rescue basically every company out there. Central banks will print us out of the problems, but of course that's pretty naive. And so far, I mean, we haven't seen any major bankruptcies, any major problems coming from the real economy. But it's obvious that this will happen in the next couple of weeks. So I think everybody who believes in this V-shaped recovery is probably a bit naive. But gentlemen, what would you say are the most dramatic consequences, both for business life, for financial markets, and for society? I mean, it's obviously going to be more market interventionism, less free markets, less capitalism. I think there will be tremendous implications for our our liberties in terms of social life. What's from your point of view the most dramatic impact on the whole crisis?
Who would you like to start?
Let's go with Rick.
I need to disclaim, first of all, that I'm not a political scientist, a social commentator, or an economist. I'm a credit analyst and an investor. It's difficult for me to understand how you can have an economic slowdown of this magnitude and escape in any way unscathed. The idea that, as an example, the service economy is basically down makes me wonder how individual balance sheets are going to work in a circumstance with record individual debt. The small business debt in the state of California has actually been in pretty good shape, but I wonder if it's in good enough shape to survive the sort of decline in economic activity that we're seeing. If you have no income, you can't have any outgo. There's a wonderful old saying that if your outgo exceeds your income, your upkeep becomes your downfall. And one wonders, in a circumstance where there's almost no economic activity, how we reconcile that little ditty. I think, as you say, Unfortunately, the people, and I don't mean all people, but many people on the street, while they're scared, believe that the big thinkers of the world will stick handle, in Canadian parlance, this circumstance in the same way that they are alleged to have stick handled 2008, 2000, 1987, 1980, and 81. While I would argue that it's the big thinkers that cause those problems, I think the person on the street believes that they are responsible for solving it, and they're looking to them to solve the problem again. Now, in the United States, if you happen to be a Democrat, you probably believe that Trump is the problem. If you're a Republican, you probably believe that Pelosi or Biden or whatever the schmuck that just dropped out, you probably believe that they are the problem. I would describe that whole political class is the problem, but that's introducing politics into the question that you asked. My suspicion, my sense is that we need a reset, and I have no idea how that reset occurs. Perhaps the way Jim describes, perhaps in some, if it's possible, messier fashion. I'm nervous that when the political class is unable to deliver a solution that satisfies the sort of collective want of the people, that the response won't be good. I'm not apocalyptic. I'm actually a fairly sunny, fairly optimistic person. But I wonder what happens when the people are used to having their expectations met by the political class, and the political class doesn't have sufficient tools to meet the population's expectation in the near term. That's answering the question from an American point of view and from a Californian's point of view. From a human being's point of view, looking at the world, my primary concern is that this damned virus doesn't hit the third world shanty towns. When I think about how inconvenient it is for me to have to be concerned about going to the store as a 65-year-old during seniors hour and wearing a mask, when I juxtapose what might be my concern, the inconvenience I feel, with the thought of a highly contagious disease hitting the shanty towns of Mumbai, Kinshasa, Lagos, that really puts my concerns in perspective. You know, the last thing I want to say is that the longest unbroken bull market that any of us can observe is the ascent of man. And not my suspicion, my certain knowledge is that we get through this. It won't be pretty. Hopefully we use this circumstance as individuals and as societies to make ourselves, in Taleb's framework, anti-fragile. If we make ourselves stronger, our families stronger, our companies stronger, our relationships with our neighbors and our customers stronger, those individual actions will do more to strengthen society than any amalgamation of the political class. But I think there's going to be a reckoning, or a series of reckonings, between now and then. From my own point of view, and I'm sure from the point of view of everybody on this call, one of the keys to getting through this circumstance and coming out of the reckoning in good condition will, unfortunately, be gold. For all the reasons that you know. It's an asset that isn't simultaneously somebody else's liability. It isn't a promise to pay. It's in fact payment itself. So I suspect from our point of view that the circumstances that we need to accommodate ourselves to will be less unpleasant as a consequence of the fact that for the last 10 years, we didn't listen to more popular noise. But the idea that we can get through this unaffected as a consequence of the fact that we were brave with regards to gold when others are afraid, I think is incorrect. I suspect that we all have to get through a lot of strange circumstances, and I would urge everyone on this call to the extent that you can, be generous as you can afford to those who didn't prepare.
Great point. Yeah. Thank you. Jim?
Yeah, I agree with almost everything that Rick said. One place where I take exception, he described the ascent of man as a longest continuous bull market. I would say that it is a bull market, but it's not continuous. We have two examples of global collapses of civilization. I'm still researching a third, but the data from early antiquity or borderline prehistory is sketchy. But the two examples we have are the 12th century BC, the collapse of Bronze Age civilization, which is a very prosperous era of globalization, by the way, before it happened. They found one vessel off the southern coast of Turkey. There was what's the right word? There was a circular trade in the Mediterranean because along the northern shore the winds blew to the east, and you sorry, to the west rather, so you could start in present-day Lebanon or Phoenicia at the time and make stops in Turkey and Greece and Italy, and then come down and go through Carthage and back the other way. And they found a cargo vessel with amber, which came from the Baltic area. They also found gold, which came from Sudan, present-day Sudan at the time, and they found lumber from Lebanon. So basically all these cargoes were being swapped and traded and sold in all these ports. Very prosperous era, the Mycenaeans and Hittites and other civilization, and they all collapsed. Not one, not two, but all of them, and the evidence is pretty good that something very similar happened in China. The second collapse, of course, is in the 5th century AD with the fall of the Western Roman Empire, but that also coincided with the collapse of empires in India and elsewhere. So they do look like global collapses, and that tempo for the two data points we have is every 1,500 years, and it's been 1,500 years since the last one. So using two data points, I would just query whether we're not in for something bigger, although we will get through it. Now, I grew up in the 1950s and early 60s. I did not live through the Great Depression. I did not live through World War II, but my parents did, and my grandparents did. And so I was raised under their influence. And I remember we saved rubber bands. It was a shame to throw away a rubber band. We would, as Boy Scouts, or even Cub Scouts, we'd go out with our wagons and we would collect tin cans and newspapers. And we weren't doing it for environmental reasons. Maybe that's why you would do it today. But tin was valuable. It had steel in it. You could use it to make automobiles or tanks. And newspapers could be reused and had value as well. So my point is, I grew up with a depression mentality, even though I didn't live through the depression. And the bigger point is that when you have a change like that, a change in mentality because of extreme economic circumstances or World War II, and of course the two went back to back, it lasts for 30 years. It lasts for a couple generations. It's not over in 6 months or a year. The change in psychology is profound. And so, whether you're a millennial or a Generation Xer or even younger, when you've seen a third of your savings wiped out for the second time in 10 years, and unemployment this time is going to be 25%. It'll come down from there, but it's probably going to hit 25%. Forget 10%. We saw 10% in 2008 global financial crisis. We saw 10% approximately during a very severe recession in 1982. Now we're talking 25%. So the 1980 baseline, the 1998 Russia long-term capital crisis, the 1994 Mexican tequila crisis, and you can think of the dot-com crash. None of those are good baselines for understanding what's happening now. You have to go to 1929. Which is outside the living memory of everyone alive. I mean, if you're 98 years old and you remember the crash, fine, but there are very few people who fit that description. So for all of us, there's no living memory of that. We have to get it from books and statistics and study and other sources, which can be done. The Dow Jones Industrial Average fell 89.2% between 1929 and 1933, not 27%, which is where we are today, or 30%, or 50% or more, which is what we saw in 2008, but 89%. That's what a depression looks like. That's what a true bear market looks like. And no one is ready for that. No one is prepared for that. But as I say, the effect of that will be intergenerational. And of course, the solution, which I already mentioned, was devaluing the dollar against gold. So that's one thing. Rick mentioned shanty towns in around the world, South Africa. You don't have to pick on South Africa; they're all over the world. He's absolutely right. I'm equally concerned with shanty towns in Los Angeles, San Francisco, Seattle, and New York. You don't have to walk very far to find them. And these are people who don't wash their hands 10 times a day and don't live in sanitary conditions and don't avoid social distancing or embrace social distancing, etc. So, and we're just catching up with data. The data is incomplete, and you have to use inferential method or Bayesian techniques to even draw semi-reasonable inferences, even though humility is a good place to start. No one knows exactly what's going to happen, but there's good reason to believe that the decline of the fatality rate and hospitalization rate are not linear, that or even normally distributed. That's more of a sine wave. In other words, it will go down. It appears to be getting better in a lot of places, but there'll be a second wave, and then a third wave, and we're already seeing the second wave in China, and we may see it elsewhere. So. And there is no vaccine, period. There are some treatments that have promise, and that's great. Let's bring on the treatments, but that's not a cure. And there's some reason to believe that this is seasonal. So maybe we'll catch a break in the summer with more heat and humidity, although the opposite is true in the southern hemisphere, of course. So let's see what goes on there. But maybe we'll catch a break, but every reason to believe that there'll be a second wave of infections, a second outbreak, if you will, or spread is probably a better word, in the fall, and that this is far from over. So combining the profound psychological impact of this, what I would describe as an intergenerational impact, with the fact that this isn't pneumonia or anything else that's under control. It's not under control. I would look at and forget the V-shaped recovery. I mean, I'm already tired of hearing. Larry Kudlow, the president's chief economic advisor, has the worst forecasting record of any individual institution I can think of, with the exception of the Federal Reserve and the IMF. They are actually worse, empirically worse, but Kudlow's pretty bad. But whether it's Mnuchin, Kudlow, or the president, talking about pent-up demand, as if to say this is just a big fat timing difference and all will be well in the third quarter. But remember, go back to 2009. What did we hear? Green shoots. Remember green shoots? And 2009, 2010, Secretary Geithner and others were talking about, Joe Kiernan, CNBC, talking about green shoots. There were no green shoots. We got brown weeds. I mean, the growth from 2009 to 2020, as I mentioned, was 2.2%. A full percentage point below the post-1980 trend, even further below the post-World War II trend, and slower than the increase in the debt, which is why the debt to GDP is where it is. And not much difference under Trump and Obama, all this talk about Trump's economic recovery. I mean, it was the same recovery. And just look at the data. It's the same rate. We did not have a single 3% year, not one. The data is pretty clustered around 2.2%, not much variation, and not much difference between Trump and Obama, which means that there were larger forces in play, which were demographic, debt, technology related, that created persistent deflation, which the Fed was barely able to offset with money printing. I know it was a tug of war. If you just take the quantity theory of money, nominal GDP was punk, but that was a bitter contest between money supply and velocity. Velocity declining, money supply increasing, and it's a simple mathematical identity, and we were barely able to keep nominal GDP on track. So now this idea of pent-up demand. Look, my wife and I usually go out for dinner on a Friday night. We didn't go out last Friday. We're not going out next Friday. But let's just say by July, things are better and the restaurants are open and we go out for dinner. We might do that. We're not going to order 3 dinners or 10 dinners. We're going to order 1 dinner. In other words, that's a permanent loss. That's a permanent loss. Now, if I was thinking of buying a car last week and I decided not to go because the deal was closed and I go out in August and buy a car, that's a timing difference. I shifted that expenditure from the second quarter to the third quarter. But okay, so we get permanent losses and temporary losses or timing differences. How do you break that down across the economy? Well, what do we know? We know that 70% of the U.S. GDP is driven by consumption, and we know that almost 70% of that is services, not goods. In other words, just based on that, it looks like most of these losses will be permanent, not temporary. And how do you recover that, if at all, with 25% unemployment? Good luck. So there are psychological aspects, there are empirical aspects. There'll be a little bit of pent-up demand, but nowhere near equal to the actual losses. And that the real bottom line here, and I'll just digress briefly, we have a compressed but interesting, scientifically interesting model of this, which was the Fukushima event, March 2011. So what happened there? You started with an earthquake, a pretty bad one, underwater. That caused a tsunami. It didn't have to. You can have an earthquake without a tsunami, but this one caused a tsunami. The tsunami came ashore and crashed into a nuclear power plant. Didn't have to. Could have hit a barren island somewhere, but it didn't. Hit a nuclear power plant, and the Tokyo Stock Exchange crashed. So what you had 4 normally independent, non-correlated, complex dynamic systems crashing into each other. The tectonic plates for a complex dynamic system, hydrology or hydrodynamics for a complex dynamic system, radioactive plant is a complex dynamic system, and the capital markets are a complex dynamic system. But you went from tectonics to hydrology to radiology to capital markets, so you had one complex dynamic system crashing into the other and interacting in ways that are completely unpredictable. I mean, you can kind of see them after the fact. So what do we have now? Well, epidemiology is a complex dynamic system. Spreads of pandemics are half biology, half math. I don't claim to be a biologist, but I'm pretty good at the math, and you can see this, the superlinear functions in terms of the spread crashing into the economy, which is an even bigger complex dynamic system with large psychological inputs that are hard to quantify, crashing into politics and geopolitics. So now, one of our relatively small number of deployed nuclear aircraft carriers is offline. It's sitting in Guam with a crew that is spreading coronavirus, so it's offline. Well, that carrier was deployed to defend the Straits of Taiwan. Does China get antsy now? Well, let's see what happens. But we see what's going on elsewhere. And then finally, what's the next complex dynamic system to get whacked? The answer is civilization. So I would expect to see social unrest, and that could lead to violence. And when Rick said he's cautious about going to the grocery store because of possible airborne spread of the virus, that's prudent. That's very prudent. But we may get cautious about going because of armed robbers or people hitting you over the head with a lead pipe. So that's where it goes. Lawyers have an expression for that. It's called self-help. It's when you're frustrated with the legal system, the judges won't help, the lawyers won't help, the courts won't help, the police won't help. You just do it yourself. You take it upon yourself, and it's called self-help, and it's actually recognized in common law. Well, self-help in this case means looters and vigilantes, and that could be next.
Thanks, Jim. I would say as we've got Rick as a special guest, we should also talk about markets and especially commodity investments. Rick, I assume that you're legally not allowed to mention specific names that you like in particular, but if you could give us like a very broad overview about the commodity space, what you like best. I mean, the gold space is doing extremely well. I think the numbers for the first quarter should be really good. I think from a technical point of view, there is no sector that looks better at the moment. So I think that the mining space really will come into the spotlight again. Even uranium is moving. I think copper is very interesting. Of course, the energy market has been extremely volatile. And one thing that I wanted to ask you additionally is, I remember at Minds and Money in London, I think it must have been 2015. And I arrived there and I thought, okay, did I mix up the dates? Because it was basically empty. And you delivered a presentation right in the morning, and that was like really the bottom of the market. Gold was trading at 1,100 and the commodities sector was basically dead. And you said you're seeing tremendous opportunities on the debt side. And I thought that was really interesting, because most people in the commodities space, they only invest on the equity side. So could you give us like a rough overview what you like best at the moment?
Yeah, in the context that this is very rough, as Jim says, the future is uncertain. And actually, when I'm asked to make predictions, I always sort of think back to Buffett's famous quote about predictions can often tell you a lot about the predictor, but often not very much about the future. So I'd like to make my own remarks hedged by that. In my markets right now, there are two places that investors need to be. One is cash. The truth is that the purchasing power of your savings denominated in euros or dollars or anything else are going to decline over time for the reasons that we've described and for the reasons that Jim has so wonderfully well put in context. But in the near term, irrespective of the fact that devaluation means that your purchasing power declines over time, having the liquidity in a liquidity crisis means that you have the tools and the courage to take advantage of the circumstance rather than to be taken advantage of by the circumstance. The second is gold. The policy response to the circumstance that we find ourselves in is almost invariably good for gold for a whole bunch of reasons. In my experience, and I grant to Jim the sense that this time is perhaps more severe than what we have seen in the past, but if you observe gold and gold equities markets for the last 45 years, which is something I've done, there are some fairly predictable patterns. First of all, gold is, and gold stocks are extremely cyclical. Mm-hmm. And they vary imprecisely, but they vary, I would say, in correlation with faith or lack of faith in fiat alternatives, particularly the world's reserve currency, which is to say the US currency. Circumstances where gold and the dollar are strong simultaneously almost always are a consequence of the weakness of competing fiat currencies. In other words, rather than necessarily the strength of the US dollar or the US economy, they're much more frequently, when gold and the US dollar move in concert, reflections of the weakness of alternative currencies. And I think we see ourselves in that fashion. I won't make the gold case other than to say the set of circumstances that we find ourselves in seem to me to be fairly attractive for gold. In my experience, gold must move first before the gold stocks move. People buy gold out of fear, and they buy gold stocks out of greed. In order for that greed to be stimulated, the increase in the gold price needs to be reflected in the income statement of the gold companies, and then later in the balance sheets. Again, looking back at history over 45 years, what you find is that the gold equities market, or the gold market as a whole, including the equities and the metal, moves very much like a circus master's whip. The front of the whip moves first, of course, that being gold, then the large cap, high quality gold stocks, then the mid-tier producers, then the junior producers, then the exploration sector. And I would suspect in this circumstance that past is prologue, which is to say gold is moving now. The gold stocks haven't caught a bid because the gold stocks have been such serial underperformers in the past. One must look at the circumstance around the gold producers and understand that we're faced with a reasonably virtuous set of circumstances. what they produce seems to be going up in price in any currency that people spend. The second thing is that at least in the near term, the management companies of those, the management teams behind those gold companies, pardon me, are a little constrained from stupidity given the history over the last 15 years. The fact that they wasted the last bull market so completely is amazing. If you look at the 2000 to 2011 gold bull market, where the metal moved in US dollar terms from $250 to $1,900, the free cash flow per share in the index declined. It took real skill to waste a bull market like that. The consequence of that is that about 70% of the management teams were allowed to pursue other employment opportunities. And I think in the very near term, that experience will cause the gold mining companies to behave much more intelligently. Beyond that, for companies that produce gold outside the United States, their costs are denominated in their domestic currencies, which are going down, while the product that they sell is denominated in US dollars, which is going up. It's also pretty hard to screw that up. And I think that you're going to see margin expansion. And I think the other reason that you're going to see margin expansion is that in most mining companies, one of the chief input costs is energy. And if one of your chief input costs has declined really extensively, it has to help. So my suspicion is that people need to own physical precious metals, starting with gold, but also silver. And people need to begin to buy the gold stocks to the extent that they have the ability to do that in a way that doesn't compromise their other savings. If you look at the broader commodity index, and we have a 100-year commodity chart available for anybody who cares, what you'll find is that commodities measured against many other forms of financial assets are at 100-year lows. I don't think that people other than speculators need to become involved in broader commodity markets yet, because my suspicion is that although at these commodity prices, there is no ability for companies to add productive capacity or even to maintain sustaining capital, that the truth is that although supply declines in the current pricing environment are absolutely inevitable, demand, I think, in the near term could fall as fast as supply. An example would be in the oil market, where everybody is looking at the decision by the Saudis and the Russians to take on the Americans. The truth is that the cure over time for low prices is, in fact, low prices. If you make oil, and this is for illustrative purposes, is not an investment recommendation, but if on a global basis, according to the International Energy Agency, you make oil on a fully loaded basis between $50 and $60 a barrel. Fully loaded means you add back prior year write-downs, which the industry hates to do, and you add cost of capital. But if you make the stuff for $50 a barrel and you sell it for $25 a barrel, and you do it 90 million times a day, that is, if the industry as a whole loses $1.8 billion a day, that gets sort of boring. And beyond boring, it gets unsustainable. Over time, irrespective of the policy response, what happens is that the companies don't make sustaining capital investments. They can't fund new projects. And the consequence of that is that you have a supply decline, and supply and demand balances as a consequence of supply falling. With demand falling simultaneously, that can take much longer to take place than you think it will. But the truth is, unless you believe, or unless you drive a Tesla, unless you believe that when you walk out to your garage 6 years from now or 7 years from now and turn the key to the right, that the car won't start, you believe that the price of oil will rise to the cost of production, including the cost of capital over time. And you believe that for copper, and you believe it for uranium, and you believe it for that whole host of products. In the near term, however, that doesn't have to happen. We found in commodities, because of stranded capital, because of the amount of money that was invested in the oil business, as an example, over the last 15 years, that supply and demand don't have to balance in the near term. What we in the United States called the gas bubble in 1980 turned into the gas sausage. We had so much productive capacity, that we were able to produce below the cost of production for 6 or 7 years. And that can happen in the broader commodity space. So look at the broader commodity space as a contrarian investor. But right now, focus on precious metals and precious metals equity. Remember, gold moves first, silver moves second. After gold is moved, the gold stocks move. And finally, assuming there is liquidity in the markets, the silver stocks, because of the volatility of silver and the scarcity of high-quality silver names, move the furthest. Now, my suspicion is, to restate what I stated before, that the first move will occur in the higher quality gold companies. They're also the easiest ones to participate. If you look at a 45-year chart, the Barron's Gold Mining Index chart, as an example, what you will see is that over 45 years, there have been 8 recoveries from oversold bottoms. The worst of those recoveries has generated an index return, not an individual stock return, but an index return, varying between 180%, as I read the chart, and 1,200%, as I read the chart, over periods of time as brief as 13 months or as long as 42 months. What that suggests to me is that you don't have to work too hard early in a bull market to attempt to beat the beta in the market. The beta in the market is extraordinary. So begin your gold stock investing quest by owning the best of the best. De-risking your portfolio in the face of a market that will give you beta between 150% and 1,200% is probably good enough. So that's where I would start.
Thanks. And we quoted you, Rick, in our last gold report because you brilliantly put it. You said, for the first time in my lifetime, the gold mining industry has actually decided to become an industry rather than a floating abstraction. Love it.
I may have been too generous. We'll see.
Jim, Heinz, what are your thoughts on market developments?
If I may, first of all, I want to say something about the gold industry. One of the reasons why they have this tendency to squander capital is in boom times, so much money is flowing into the industry, and it's simply too much, and they don't know what to do with it. So that is actually their main problem, that they get too much money when the boom is on. So we will see how they will handle it this time. It's not the case at the moment, but it's going to come. It's going to happen. And then, well, I was actually short during the crash, and what I did then was I took profits and I deployed around half of my profits into gold stocks and cryptocurrencies, and I kept a cash reserve. So I'm basically on the same page as Rick is with regards to this. At the moment, I think one should be long gold stocks. And, well, like I said, I'm adding cryptocurrencies as well because I see them also as beneficiaries of what is currently happening.
Jim, what are your thoughts?
Right. I certainly agree with everything Rick said about how this plays out in commodity space. The only drop one quick footnote on oil, and Rick is exactly right about the long-term cycles, but there's another factor which we have to put in the equation, which is politics. We are in an election year, and both sides are out to win. And if I had to pick one state, you can do 10 states that will decide the election. The other 40 might as well stay home because we know how they're going to turn out. But of the 10 states that decide the election, if you had to pick one, where the pivoted election would be Pennsylvania, which has a very large fracking industry and with good unionized high-paying jobs with benefits. So we somehow managed to get a price war between Saudi Arabia and Russia in the middle of everything else that's going on. Whether that was opportunistic timing or just unfortunate coincidence, there it is. But the message is being delivered to MBS that he has to make nice with Russia, agree on output cuts, and get the price of oil up fast. And if that doesn't happen, he might not be around. So I would look for oil to rally pretty significantly, not because of any supply-demand fundamentals, but because of just outright supply, manipulation policy, call it whatever you want. Partly because those jobs have to be protected. Because everything Rick said is right, but if the correction for low prices is low prices, that's right, but it takes time and involves a lot of bankruptcy and asset sales at 10 cents on the dollar and revised price structures. It's a very messy, elongated process, but you could be looking at tens of thousands of layoffs on top of everything else that's going on. I mean, we have 10 million layoffs. Why worry about those jobs? Well, those jobs are high-paying jobs in states that will decide the presidential election. So they've got to get the price of oil to around $35, which is, close to break even for the fracking industry, close enough to keep the doors up and keep the lights on. So I would look for a short-term rally in oil that may even be counter-trend to the bigger deflationary rallies and the process Rick described, and he's right, for purely political reasons having to do with Texas and Pennsylvania and the fracking industry. And I just kind of endorse everything Rick said about gold. And I always say you don't have to wait for central banks to go on a gold standard. You can go on a personal gold standard. Just go buy some.
I would have one last add-on question for Jim in this regard, actually. So we've been talking about falling velocity, and you, I think, rightly said so and pointed this out quite often. I think once with the analogy, you need a ham and cheese to make a ham and cheese sandwich, right? So the cheese being the velocity is missing. Clearly it is. Well, you also, on the other hand, often point to the point of the loss of confidence. So we would need to see something between now, which is this huge deflationary trend, which is probably preventing monetary inflation to actually create price inflation, to an actual loss of confidence because the price inflation is already so high. So what other than a revaluation of gold, which you mentioned, could do you think trigger that? That would be very interesting for me.
It's a great question and an important one, because I told you how to get inflation in 15 minutes by raising the price of gold, but I didn't say that I thought that would happen anytime soon, and it probably won't, almost certainly will not in the short run. Even if our friend Judy Shelton is confirmed for a board seat and then later becomes chairman because of Trump's disenchantment with Jay Powell, that's a space to keep your eye on. But let's assume that the Fed doesn't do what I just described, or for that matter, the Treasury doesn't do it. And I think that's right. There's so start with the question: why did the Fed stop its balance sheet expansion at about 4.5 trillion at the end of QE3? And I talked earlier about how they wanted to get it back down so they could do it again in the next recession, which here we are. But why? Why not just keep it at 4.5 trillion, not do QT, quantitative tightening, which nearly caused a recession at the end of 2018? And if you had another recession, take the balance sheet to 10 trillion. I mean, why not do that? And the answer is, and they've never said this publicly, and this is my inference, they felt that there was some limit. There is no legal limit, by the way, just to be clear. There is no legal limit. My friend, the former board member of the governor of the Federal Reserve, was correct when she said central banks don't need capital. But in my view, they felt that there was an invisible confidence boundary. No one knows where it is, but there just comes a point where you don't need a PhD in economics. You just look up, you read the headlines, and you say, you know what, I don't know what's going on here, but I don't like it. Get me out of the dollar fast. And you could buy gold or silver, of course, but you could buy real estate. You could buy fine art. You could buy natural resources. You could buy a lot of things, but you just want to get out of the dollar as fast as you can. And we did see exactly what I'm describing in the late 1970s. So now on the other side of that, and this is something I talk about at length in chapter 5 of my new book, Aftermath, we have modern monetary theory. And modern monetary theory is pretty simple, which is, and the big brain here is Stephanie Kelton, Professor Kelton, the State University of New York, but she's the bright light, if you will, of modern monetary theory. And she says a number of things, and I've read all of her technical papers, so I'm not giving you the pop version of this. She said there's no distinction between the balance sheet of the Treasury and the Fed. They should be thought of as a consolidated balance sheet. The Treasury can spend as much as they want. She actually goes so far as to say that how do you get any GDP if the Treasury is not spending money? As if the private economy didn't matter, but she said if the Treasury is not spending money, that's where your GDP comes from. If they need to borrow, they can borrow it, and if the banks are not willing lenders, the Fed can monetize the debt, and there's no limit on the Fed balance sheet expansion. So if you think about that, there's a consolidated balance sheet. Well, I attacked that, or I didn't attack it. I dissected it and offered my rebuttal, which is that legally the Fed can go as high as they want, but psychologically there's a boundary, and you don't know where it is until it's too late. You find out the hard way where that boundary is. Now, the difference between what I wrote about in Chapter 5 of Aftermath and what Professor Kelton said and what I've been saying, and reality is here. We are actually seeing MMT in action. Let me just give you a very concrete example. I said earlier that the Congress authorized $450 billion of new capital for the Fed. So the Treasury is going to borrow the money and give it to the Fed, and the Fed's going to expand their balance sheet. Well, one of the things that the Fed is going to do with the money is buy these small business loans, which was a separate approximately $380 billion program. Well, the banks are lending to small businesses, with some fits and starts, but they're getting the money out the door. I think $100 billion has already been committed or actually advanced. Well, doesn't that clog up the bank balance sheets? Well, maybe, but the Fed has announced that they're going to buy the small business loans from the banks. In other words, something like $380 billion of the $4.5 trillion balance sheet expansion is going to go to buy the SBA loans from the banks and put them on the Fed's balance sheet. Again, perfectly legal. Oh, well, that's interesting. Well, where does the Fed get the money? They print it. Where does the Treasury get the money to invest in the Fed? They borrow it. Well, who buys the bonds? The Fed. How does the Fed buy the bonds? They print it. In other words, we have a perfect doom loop between the Treasury and the Fed. We have exactly what modern monetary theory advocates. We may not be using the money for the projects they had in mind, but the economic process is identical. In fact, we are witnessing an experiment in modern monetary theory, where the Treasury and the Fed act like there's a consolidated balance sheet, and one borrows and spends, and the other one prints money and monetizes and holds the assets on the balance sheet. Will it work? I'll suggest that we're going to find out. But to answer Mark's question, if the psychological shock that converts deflation into hyperinflation in the blink of an eye is not a government-mandated devaluation of the dollar against gold, it could very well come quickly as a revulsion against the expansion of the Fed balance sheet.
Thanks a lot, Jim. That's highly interesting. Actually, there was an article by Jim Bianco. You probably saw that perfectly explained the difference of those programs. This CPFF, PMCCF, TALF, SM, CCF, and somebody wrote the more acronyms used, the worse the crisis. But he perfectly explained how basically the Federal Reserve just creates those SPVs and the Treasury invests into those SPVs, and how more closely now politics and central banking is aligned. Gentlemen, let me end this discussion with a great quote by Stephen Poloz, the governor of the Bank of Canada, and we used it for one of our new keynotes. He said, "A firefighter has never been criticized for using too much water." So I think in doubt they will probably do way too much. Of course, this should positively affect gold and, let's say, our asset classes, but it's also kind of scary, and it's I think Rick put it brilliantly. It's not about only capital markets. It's about our society, and actually the whole the whole fundament of our society and our lives that is questioned at the moment. And I happen to read The Fourth Turning by Neil Howe at the moment. It's very much reminds me of things that are going on at the moment. Gentlemen, it's been a great pleasure as always. Rick, hope you enjoyed it. Thank you very much for joining us. As always, we will write a transcript and then send it to you for proofreading and for your confirmation, and then we will publish it. Gentlemen, thank you very much for taking the time. Happy Easter holidays, and yeah, be safe, be healthy, and take care. Thank you very much.
Thank you all.
Thank you.
Easter.
Thank you. Happy
Bye bye,
Easter.
everyone.
Bye bye. Thanks.
Cheers.
Bye.
Thank you, everybody. Bye bye. Thanks.